What is technical analysis in stock market? Technical analysis of stocks is a method of analysis of stocks by using historical chart patterns of stocks which are publicly available. In other words, technical analysis means predicting the behavior of the stock price by looking at the previous trends of price and volumes by using their charts and other technical indicators. It is generally used by short-term traders who want to make quick money by observing patterns in stock prices. They do not concern themselves with the overall health of a company and are not interested in knowing the fundamentals of the company before investing in it. Fundamental analysis of stocks focuses on companies' financials, management, economic policies, etc. to do an analysis about which we'll talk in another video. On the other hand, the technical analysis of stocks focuses on past price charts patterns and predicts the future price of the stocks. Both fundamental and technical analysis is used for future price prediction of stocks but takes different data into account for analysis. Following are the 12 important steps of technical analysis of stocks to understand Dow's theory of technical analysis. 3 of Dow's investment theories are a good guide to technical analysis which serve as the basic assumptions behind technical analysis. Following are the theories which explain how technical analysts use them. The stock market reflects all known information. According to the first theory, the stock market reflects all known information. Known information refers to all those information which are available by any means publicly. Technical analysts don't take any financial information into account for analysis. They don't relate themselves to price to earnings ratio, return on equity ratio, shareholder equity, or any other ratio like fundamental analysts. Price movement can be predicted. According to this theory, the price movement of stocks can be predicted and charted. Everyone knows price moves randomly and there is not a fixed pattern, but as per theory, this case is not always. Price movement repeats itself sometimes or moves in a known trend. Once you understand the trend, it's quite possible to make money. You can go with the strategy of buying at a low price and selling at a high price. Also, you can make good positions for future trading. History repeats itself. This theory tells that the history of stock market repeats itself, means investors and market players react in the same way as they reacted in the past because of the same situation, news, or company announcements. So technical analysts use their knowledge of how a trader reacted in the past and what was the effect on the stock. Focus on short period. Technical analysis of stocks focuses on a short period of time, like as long as 1 month and shortest of 1 minute also, as the purpose of the fundamental analysis is an investment for long term, but in technical analysis the focus is for short period. If you want to make money in a short period or buying and selling repetitively, then this method of analysis is best suited for you. Use charts and graphs for stock price trends. Technical analysis of stocks use charts and graphs to read spot price trends. A chart tells you a lot about trend of price movement. Where the current price of a stock is heading can be easily predicted through charts. Trends can be classified on the basis of duration and types. Uptrends. The upward movement is known as an uptrend. Every day stock price moves towards a new high and then falls to low as they did previously. You must know that this upward movement at its high is not lifetime high, but it could be high of the last day, week, or month. This steady low and high price reflects that the market is positive about the stock. It is an indication that one can buy the stock as this is an upward trend. So every time when the stock falls, investors take it as a chance to buy. They don't wait for the price to fall further. Downtrends. Downtrends refers to patterns where stock price falls continuously. You can notice not only peaks are lower but troughs are also lower. It means market players are convinced that the stock price will fall further. So investors wait to a little rise in the price to sell their existing positions. At this point in fall, investors never prefer to buy further because of its downward trend. If you are a short-term investor, then it will be a loss-making position for you. But if you are a long-term investor, you may wait for a little more price fall. Horizontal trends or sideways. A horizontal trend is a trend in which there is no fixed trend, only peaks and troughs are constant. But you can't decide where to buy or sell a stock. Support and resistance. Support and resistance are two main concepts of price movement in technical analysis of stocks. Price of stocks stops and reverses at a certain predetermined price level. Support is a price level where a downward trend of a price movement is expected to stop. At this point, the price of the stock falls and demand of the stock increases, which forms a support line. Resistance refers to the highest price of a stock where it reaches before traders start selling and stock price to fall again. Once the area of support and resistance is identified, trading will be easier for you, as if the price reaches any of these points, there are two possibilities. First, it may break that level and go upward or downward. Second, bounce back away from any of the two levels. Attention to trade volume. While performing technical analysis of stocks, if you want to be confident about the trend of the stock price, volume of trades must be watched. You can get much information about what is happening in the market through trading volume. If the volume increases with the increase in price of the stock, the trend is probably valid. And if the volume of the trade increases slightly, probably it is due to reverse trend. Use of moving average technique for removing minor price fluctuation. Moving average is a technique to get an idea of a set of a trend. It is useful for forecasting of long-term investment. This method removes unnecessary highs and lows to make overall trend visible clearly. There are many methods for moving average, such as simple moving average, weighted average, and exponential moving average. Use of indicators and oscillators. Indicators is a calculation of technical analysis which supports the trend of information of price movement. It helps you to come to your decision to buy and sell. Leading indicator is useful during a horizontal trend when the movement of the stock is not fixed. Let us now talk about technical analysis of stocks by chart. There are 4 kinds of charts that can be used during technical analysis of stocks. Firstly, the line charts. They are plotted by joining closing prices of any stock or index. They can be prepared by checking closing prices on monthly, weekly, and even hourly basis. Bar charts. Bar charts depict all the 4 key prices of the day, namely open, low, high, and close. This picture shows how a bar chart can be made and how it shows a positive or negative sentiment during the time period. Candlestick charts. These are the most important ones and the most commonly used by traders. They also depict the open, low, high, and close prices of a stock. It looks like the picture shown here. And a candlestick has 3 parts: the real body, the upper shadow, and the lower shadow. We'll talk more about candlestick charts later. Point and figure charts. They depict price movements without considering the passage of time. They consist of X's and O's that represent price movements in different directions. X's represent a rise in prices and O's represent fall in prices. One X on a graph means one price unit rise and one O means one price unit fall. If a stock price unit has increased 4 times, a column of 4 X's is plotted. Therefore, X's and O's can never appear in the same column. Thank you for watching.